Holden, if you ever decide to go back to school, this is the type of stuff you'll be learning. Believe it or not. Do you ever want to go back to school, or are you happy where you are?
So I actually am in school.
Oh, you are?
Believe it or not. Yeah,
Okay.
I do Santa Fe classes right now online.
Okay, that's cool, too.
So I'm doing economics.
Oh, well, yeah, granted. Okay. Well, hey, look at the audience. Hey, everyone, welcome to Youth Bombs. I'm Coleman.
I'm Holden.
And then, so we're just looking at, we're both students here. I'm a master's. He's an undergrad at Santa Fe. We're looking at economics. And then specifically, I just spent a month learning about insurance in America and figuring out like the theories behind it, why do we have it, et cetera, et cetera. And then how in the world does, insurance policy fit into free market capitalism? So I think just to lay a little bit of the groundwork, there's a lot we can go into, but here, let's first explain, Holden, if you can. I'll add on to it. The theory of actuarial science, uncertainty and risk. Why do we care about risk? Are people generally risk averse? What's the deal with that?
Yeah, so I mean, the only reason, insurance insurance functions because the way it does because the future is uncertain. If the future was perfectly certain, then insurance would be you wouldn't give a claim to people that are going to have the issue, whatever it is that you're insuring, or they're going to do, or whatever it is that you're insuring against for them. So the insurance company exists largely because of uncertainty. And because if you knew that you weren't going to get in a car accident, or you weren't going to have the health problem, or whatever the case may be, you're trying to insure against, then you wouldn't buy the insurance. So I buy insurance for. I have a small lawn care company. I buy insurance so that if a rock hits somebody's window, or something breaks at somebody's place, then that will be covered up to $500,000. And the odds of that happening are pretty low, especially per visit of a yard. I don't know for sure if it's gonna happen. I like to think it won't, but I don't know the future. So that insurance policy will make it so that I could be more comfortable, and I could also, my clients could be more comfortable with me on their property. And so so anyway, the Austrian theory actually of holding cash is to hedge future uncertainty. And I believe that it would be correct. The purpose of holding cash, if you knew all of your expenditures in the future perfectly, then you would just hold that amount of cash and no other cash for those expenditures. So uncertainty plays a huge role here in insurance.
Yeah. So it is basically, insurance is the market for uncertainty. And then we're basically assuming we're living in an anxious world. Everyone's uncertain about the future. And then I think there's plenty of expenditures nowadays people would have to make that are just too expensive. Like, say, rebuilding your home in the instance of a hurricane, or car damage, for instance, or any of like injury insurance. Like here we have a whole thing of like Morgan & Morgan, Farrah and Farrah, helping people who get into car accidents and the like. Now, I think what things start to get interesting is, I think part of another interesting concept to lay out is the concept of the diminishing marginal utility of consumption, where we're basically assuming that any good becomes less useful the more you have of it. Like, so instance that like 1 cup of water is great, 2 cup of water is still good, but then an excess of water will just become, unpleasant to consume, etc. You get the point. Now, let's talk a little bit more about, I think another aspect of insurance, one more thing, is to smooth consumption into like different states of the world, where if you have insurance, you don't have to like break your bank if you have an accident. You have insurance to give you a little bit of a safety net, if you will, in the event of, an accident. So I think we agree with those theories too, right? Holden?
Yeah, uncertainty. Yeah.
Yeah. Now, I think to lay out, we have say private insurance, and then we have publicly provided insurance. And this is where we get into a bit of a mess, because now we live in a state where basically everyone expects, social government provided insurance, or it's Medicare, Medicaid, Social Security, and the like. Now, for you at home, Social Security is for, I think, mostly like retired people and veterans. I think you have Medicare, that's like for prescription drugs and the elderly, and then Medicaid, that's for poor people, basically.
Medicare 65 and older pays for all the government pays for all of it. Yeah, Medicare, Medicaid, yeah, is for poorer people, and yeah, so.
Yeah, and I think like part of like what the Austrians would argue is we would just get rid of all these like government provided stuff.
In theory, yeah, it wouldn't be like tomorrow.
Yeah.
But if but yes, we would systematically eliminate Social Security, Medicare, and Medicaid. Yes.
Yeah, and I think like part of the problem, say Republicans have been having, and libertarians, like as soon as they open their mouths about any of what you just said, lose an election.
Yeah, absolutely.
Like instantly.
Yeah, 100%. Yeah, I mean, it try and take away free health care for people 65 and older. It's just not going to work out well for you when it comes to that voter group.
Yeah. So obviously Austrians, they like to bring stuff out of the public into the private sector. So is there a vision for private insurance within Austrian economic?
Yeah. So in a free market, insurance is supposed to be for for catastrophic events. So healthcare obviously isn't necessarily like that anymore. They pay for prescription drugs, they pay for everyday checkups, and this is not how insurance would operate in a free market. In a free market, like for example, auto insurance. If you were to get your oil changed or you were to have a routine checkup, insurance would not pay you out for that, right? And not that auto insurance is completely a free market, but it's much closer to a free market than what health insurance is today in the United States. So in the United States, many catastrophic events don't get paid out, largely because of the way that it's set up and the state's involvement. And it basically makes it so that it doesn't function the same way that it would in a market economy. So yeah, we envision private insurance functioning in healthcare just like it does in any other industry. It would pay for catastrophic events. If you were to fall and break your hip, or if you were to, whatever the catastrophic event would be, they would cover that emergency for you.
Okay. Yeah, so it doesn't seem there's any problems right away. But I think now I'm going to lay a little bit of the groundwork of how economists thought it was a good idea to mandate insurance. So part of the problem with any sort of insurance, you have an issue of what's called adverse selection. Or anyway, it's a gap of information between what the insurer knows and what the insuree or the insured person knows. So, to rephrase it, I, as someone purchasing insurance, know more about my risk level than the insurance company, obviously. So let's say now in a world where one common answer to this problem of information is something called pooled premium. Let's say we just take everyone in the aggregate and create an average premium to charge everybody, right? And that's normally, I guess, how the private world would, work. But here the economist thinks, oh, wait a minute, the low-risk people are going to drop out because they're paying more than they actually deserve or than what they would need. So then they would drop out, and then that would cause market chaos.
Well, yeah.
Right.
So yeah, and by the way, so today, healthcare. I'm actually glad we're talking about it because this is a good example. So in a healthcare system today, more sick people subsidize healthier people. The way health insurance operates today, so in insurance, they're going to discriminate and adjust the price of their claims and issue claims based on the perceived likelihood that something bad will happen to you. Yeah. So or whatever they're insuring against will happen. So if you're weak and old and unhealthy and you're likely to break a hip, then you'll have to pay more to insure yourself for health insurance in a free market than somebody who's like Coleman, relatively healthy, probably not going to fall and break his hip, anytime soon. Like, knock on wood.
Yeah.
So,
Yeah.
So anyway, in a free
we can't
market,
knock on this wood though, because we have audience.
yeah, we have our audience. So it won't slam on it for you guys, but you get the idea here. If you are at higher risk, the price that is going to give that information for your perceived risk level, and the price will reflect that. So, they say, price is wrapped in information. This is a great example. It'll adjust to the perceived risk, so the company is likely going to make money, but also have an appropriate risk level, and the price will reflect that. So, when it comes to what were we talking about again?
So I think you're talking about actuarially fair pricing, and then the problem of a pooled premium incentivizing low-risk people, healthy people, say like me, to drop out of the market.
Yeah. So in a free market, healthier people like you will get a lower rate.
Yeah. Right.
So anyway, that's how a free market would function. If the government comes in and says you got to charge everybody the same thing, then it causes Coleman to subsidize people who are old and sick. And
that's not fair to me.
Yeah, and is that fair to you? I would say no. I mean, yeah. So anyway,
I think this is like, again, it contextualizes one of the complaints I've been hearing a lot with like Gen Z, for instance. Like, why are we paying for like Social Security that's supposedly going to go bankrupt in like 10 years?
Right.
Why are we paying for like the 65 and older people? Like stuff that we're not even going to benefit from in the future. Like, have you been hearing this too?
Yeah, of course, because I mean, a lot of people could see the writing on the wall. If the government is going to if the government is going to keep paying out X amount of money, going up by X percent for X amount of years, the likelihood that the Social Security Trust Fund will have enough money for you if you're retiring in the year 2060 is not very likely. And I mean, of course, if the idea is really good, then you don't need to force people to do it, we would say a lot of the time, right?
Yeah.
So, but you have to participate in Social Security. You have to participate in that Ponzi scheme. You have no choice. You have to. So, now we have 2.6 people working for per person receiving Social Security. When it was first established, it was over 150 people. So, for like every Ponzi scheme, it ends in a disaster, and that's what it looks like it's going to.
Yeah. So then now I think we can bring it into like something concrete called the Affordable Care Act. Now, let's just say like in a free market, it would be, actuarially fair to charge lower premiums to low-risk people and then higher premiums to high-risk people. But let's say I'm a politician and say that's not nice because you're discriminating against the elderly. So therefore, I'm going to impose community rating. What's community rating? Basically means you cannot price discriminate against different classes of people. So then for everyone, we get the same premium. What's the problem with that? Again, the lowest drop out of the market. So this is the Affordable Care Act. And then now that's one stool of the Affordable Care Act covered, community rating. So how do we solve the problem, though? We impose two more legs.
Subsidies.
Subsidy. So we reward people for buying insurance, and we mandate it so that everyone is supposed to like buy the insurance. And if they don't, you actually get taxed more.
Yeah, a portion tax, they say. Yeah, the Supreme Court ruled, it's not unconstitutional because the tax is apportioned, right? Did Trump get rid of that though?
I don't know, to be honest.
I think he did.
Like, hopefully he did.
That's what they said though initially, that it's constitutional because the tax is apportioned. But anyway.
Yeah, so now if you do the math of like with the basic model that in our classroom, like they basically assume two classes of people, high and low risk people, and then you work out the math. They frame it in a manner that, oh look, this solution works out. We get everyone back in the market, and then it's a fair outcome. Yeah. But is it really, Holden? Yeah.
Well, I mean, of course not. I mean, I mean, the insurance companies have to discriminate. If they don't discriminate based off of risk, then there's going to be a bunch of deadweight loss, a huge amount of deadweight loss, because one, you're going to have to tax people to get the subsidies. That's going to create deadweight loss. Two, there's going to be people who buy who shouldn't be buying. That's deadweight loss. If it's a subsidy, that makes it so that more people buy than there otherwise would have been in a free market. That's called deadweight loss. And then you got then you got people who are once again healthier, subsidizing people who are not as healthy. And so you've got a huge amounts of distortion and inefficiency now in the market because the price system is not working the way it would if you allowed capital to be bought and sold freely. So.
Yeah, and then it's good that we have also, I recently learned of a nonprofit called the American Consumer Institute that's like strictly focused on looking at consumer welfare and insurance policy.
What are they called?
American Consumer Institute.
Got you.
They look at, consumer welfare and insurance policy from like the free market and liberty-oriented perspective.
Okay.
I found them interesting. So shout out to them. And then, hey, thanks for tuning into this episode. And if you liked what we had to say, please sure to give a like, a comment, and then a share. That'd be cool. We are on Rumble and on YouTube. And if you want to contact us, we're youthbombs@alatrorepublicans.com. Thanks for listening. Have a good day. Cool.
So I know